Welcome to Talk Tickers. Today we're jumping right into the latest earnings call. Lots to unpack here.
Definitely some pretty eye-catching numbers came out.
Yeah, starting with the top line. Record revenue of $982 million. That's a 420% jump year over year. Just massive.
And adjusted operating income followed suit, up 550% to $163 million. Again, a record.
Plus, they've got this huge revenue backlog, $25.9 billion. That's up 63% from last year. Gives you a sense of the pipeline.
And a big piece of that is the OpenAI deal, right? A contract value potentially up to $11.9 billion.
Exactly. We'll dig into that. They also mentioned significant customer growth, new enterprise clients, even a new hyperscaler.
And of course, the acquisition of Weights and Biases. That brings over 1,400 customers focused on AI development into their ecosystem.
Okay, so quite a snapshot. Let's get into the details. Where should we start? Maybe that incredible revenue growth.
So nearly $1 billion in revenue, up 420%. How are they doing that?
Well, the call emphasized their ability to build and deliver compute infrastructure really quickly, basically meeting those client contracts fast.
Right. In this space, speed and, frankly, the quality of that delivery are just critical. Sounds like they're hitting the mark there.
And that OpenAI deal, while it's not fully baked into the RPO numbers yet because of accounting finalization.
It is in that big revenue backlog figure.
Correct. And they stressed it doesn't change the timing of revenue or the deal economics or the cash flows. It's locked in, essentially.
It's a huge validation. Partnering with a leader like OpenAI, it really underscores their tech position.
Beyond OpenAI, they talked about gaining traction with enterprise clients. What's the significance there?
Well, historically, their focus was maybe more on those giant hyperscale type deals.
Oh, the really massive compute needs.
Exactly. But now, seeing more enterprise adoption across different sectors, that broadens their base significantly.
And the Weights and Biases acquisition seems tailor-made for that push, doesn't it?
Absolutely. It gives them kind of a direct line to potentially thousands of AI developers within those enterprises. Yeah. It's a smart strategic fit for reaching that market.
Okay, let's look at profitability. Adjusted operating income margin was 17%. That's up 3 points year over year.
Which is pretty healthy, especially considering the growth phase they're in.
They did report a net loss of $315 million, but that seems heavily impacted by a one-time stock-based compensation thing from the IPO.
Right. That's a key clarification. If you strip out those one-off items, the adjusted figures, like that operating margin, paint a much clearer picture of the underlying operational health.
And the adjusted EBITDA, $606 million. That's nearly 6 times what it was in Q1 last year.
Impressive growth on that metric, too.
Yeah.
Shows strong cash generation from operations, again, stripping out certain items.
Now, CapEx, they spent $1.9 billion in the quarter. That's a lot of investment.
It is. And they also increased their revolving credit facility to $1.5 billion. That points to needing flexibility for more big spending.
Which brings us to the guidance. Q2 revenue expected between $1.06 and $1.1 billion.
So crossing that $1 billion quarterly mark.
And adjusted operating income for Q2 guided between $140 and $170 million. But look at the Q2 CapEx guidance, $3 to $3.5 billion.
Whoa. That's a significant step up even from the $1.9 billion they just spent.
And then the full year, FY25 revenue guidance is $4.9 to $5.1 billion.
Strong outlook there.
Full year adjusted operating income, $800 to $830 million. But the full year CapEx guidance, $20 to $23 billion.
$20 to $23 billion, that's an enormous number. It really signals their intent to build out capacity aggressively.
It really does. So, okay, we've hit the main numbers. Let's dive a bit deeper into how they're doing this and what's behind that guidance.
Awesome, good. Back to the revenue drivers, that speed and quality point. How crucial is that in practice?
Well, think about it. If you're an AI company trying to train a huge model, you need that compute power yesterday, right? Delays cost money and opportunity.
So being the provider who can deliver quickly and reliably is a massive advantage. It lets them win those big contracts.
And we mentioned the OpenAI deal accounting, just to reiterate, it's in the backlog, solidifying future revenue, even if the specific accounting line item is pending.
Right. It's a committed long-term relationship. That's the key takeaway for future visibility.
What about the new hyperscaler customer? They didn't name names, but landing another one is significant, isn't it?
Oh, definitely. Hyperscalers have incredibly demanding requirements for scale, performance, reliability.
Yeah.
Winning that business is a huge stamp of approval on your platform.
And it usually means potential for significant future growth with that single customer.
Exactly. These aren't small deals.
Technologically, they seem to be pushing the envelope. First to deploy Nvidia's GB200 systems at scale.
That's the latest and greatest chip for AI right now. Being first gives them an edge.
And getting rated platinum by semi-analysis for their cluster operations, setting MLPerf benchmarks. It sounds like their tech is performing really well.
Yeah, they're clearly focused on maintaining a performance lead. They also mentioned their own AI object storage solution.
Right, optimized for AI workloads. So it's not just hardware, they're building out the software stack too.
Which is important for offering a complete high-performance solution.
Let's talk go-to-market strategy evolution. From huge clients primarily to now actively courting enterprise via weights and biases.
It's a necessary expansion, I think.
Yeah.
The enterprise AI market is potentially vast. Tapping into it diversifies their customer base beyond just a few massive players.
But it probably requires building out different kinds of sales and support structures, right?
For sure. Supporting hundreds or thousands of smaller enterprise clients is different from handling a handful of giants. They mentioned building out the organization for that.
Okay, cost factors. We know about the one-time IPO stock comp hitting OpEx. What else?
Well, obviously, increased investment in data centers and servers to meet all that demand we talked about. That drives up depreciation and other costs.
They also mentioned higher interest expense. Why is that?
Two main reasons given. Improved payment terms with vendors, meaning they capitalized less interest, and just higher debt levels overall to fund that huge CapEx.
Makes sense. And tariffs. Any major impact?
They mentioned some elevated costs on certain equipment due to tariffs, but characterized it as not materially impactful overall. Something to watch, maybe, but not a primary driver right now.
And that CapEx strategy, they call it success-based. What does that mean exactly?
It means they primarily commit to building out new capacity, spending that CapEx after they have multi-year contracts signed that essentially cover the cost of that investment.
So it's not purely speculative building, it's tied to secured demand.
Mostly, yes. It reduces risk. But the sheer scale of the increase in guidance suggests they have tremendous confidence in continuing to sign those deals very rapidly.
It explains why CapEx can be lumpy, as they say. It depends on when big contracts land and data centers come online.
Precisely. And the updated guidance reflects stronger customer demand than they previously anticipated, leading to accelerated investments.
The guidance also includes the impact of the weights and biases acquisition, by the way.
Right. Integrating that business will have some effect on financials going forward.
One other demand driver mentioned was inference workloads. Why is that significant?
Well, traditionally, a lot of the big compute demand was for training these massive AI models. Inference is when you actually use the trained model to make predictions, generate text, analyze images, etc.
So it's the running phase, not the building phase.
Exactly. Seeing a broad increase in inference demand means AI models are actually being deployed and monetized in real-world applications. That's potentially a much larger, more sustained market than just training.
Interesting. And finally, expansion deals with existing customers. What's driving those?
Seems to be a couple of things. Demand for the next-gen GPUs, like the GB200s we mentioned, and just the general trend of AI models getting larger and more complex, requiring more power.
They mentioned customers layering contracts, maybe starting with training, then adding inference capacity later.
Yeah, that suggests these relationships evolve. As a customer's AI project matures, their infrastructure needs grow and change, leading to follow-on deals.
Okay, so pulling this all together from an investor perspective, what are the key takeaways?
Well, first, just undeniable hypergrowth in a booming market. The revenue and backlog numbers speak for themselves.
Strong validation through key partnerships like OpenAI and the new Hyperscaler.
Strategic moves like the weights and biases acquisition to position for broader enterprise adoption.
But then there's that massive CapEx commitment, $23 billion for the year.
Right. That signals huge confidence in future growth, but it will definitely impact near-term margins and free cash flow. It's an aggressive investment play.
So investors need to weigh that incredible top-line growth and strategic positioning against the cost and potential risks of such rapid, large-scale investment.
And monitor execution, of course. Can they continue to deliver these complex build-outs on time and secure the contracts to justify the spending? Plus, keep an eye on the broader supply chain and geopolitical factors, given the scale.
Okay, that makes sense. Let's shift gears slightly. Time for our This Is Not Financial Advice segment. Some outrageous but plausible trade ideas based on all this. You go first.
All right, so building on that massive CapEx and infrastructure build-out, my idea focuses on the human side. Think about who manages and maintains these incredibly complex AI data centers.
Right, you need specialized skills.
Exactly. So my outrageous but plausible idea is a speculative long position in a company, maybe even a smaller niche one, that offers highly specialized training and certification programs for AI data center technicians and infrastructure engineers.
Interesting. The idea being that the demand for these skilled people is going to explode alongside the infrastructure itself.
Precisely. It's a bottleneck, potentially.
Right.
Companies providing the essential human capital to run this AI revolution could become really valuable, maybe even acquisition targets themselves, betting on the skills gap, essentially.
I like it. A human capital play. Okay, my turn. Mine also links to the infrastructure build, specifically the power required. These AI data centers are incredibly power hungry, right?
Oh, absolutely. Power consumption is a massive issue.
So my outrageous but plausible idea is this. Look at specialized energy storage companies. Not just batteries, but solutions focused on grid stability and providing high-quality, uninterruptible power specifically for large computing facilities.
Okay, so backup power and power quality for data centers.
Yeah, think sophisticated flywheels, battery systems designed for rapid discharge, maybe even microgrid solutions tailored for data center campuses. As these facilities become more critical and draw more power, the need for absolutely reliable, clean power becomes paramount.
It's a bet on a critical enabling technology for the whole AI data center ecosystem. If the grid struggles or power quality fluctuates, it impacts these multi-billion-dollar investments.
Exactly. So a long position and a leader in that specific niche of industrial scale, high reliability power storage and conditioning.
Both interesting angles, playing the picks and shovels, or maybe the power cords and people supporting the gold rush.
Something like that. Okay, well, that wraps up our deep dive for today.
Yeah, key themes. Massive growth, fueled by AI demand, strategic wins with major players, and just huge investments to scale up capacity even further.
The OpenAI partnership, the Weights and Biases acquisition, moving into enterprise, pushing the tech edge, it's a dynamic picture.
Definitely a company operating at the heart of the AI infrastructure build-out.
So what aspects really caught your attention from this call? And what do you think the long-term implications are of this level of investment and growth?
We'd love to hear your thoughts. Join the conversation and share your insights.